as expected, it was a cracking year for Sydney Airport. It basically leveraged 5.6% passenger growth into 10% EBITDA growth and 20% growth in its cash flow. So a very strong year, leveraging off that passenger growth that was well and truly above trend. Balance sheet is in great shape. Credit metrics are pushing it towards a credit rating upgrade, and certainly Standard & Poor's have already said that they will upgrade their credit rating from BBB to BBB+ if they don't proceed with the second Sydney Airport. With that strong growth, it continues. The January traffic data came out yesterday. The international traffic growth was a mid 9% number. Seat indication data for the Northern Hemisphere summer coming into Sydney Airport is for something like mid sort of 6 to 7% type seat capacity growth. So looks like that sort of strong growth is going to continue. I just want to point out that is actually not in my numbers. So there's upside to my forecast and valuation. If this actually does continue to roll through, I'll assume that they revert more to a long-term growth rate going forward. So certainly upside there. But with that stronger volume growth does come the necessity to actually support that growth. And the guidance on the increased CapEx, increased costs is actually ahead of what I was expecting that they put out yesterday. It's resulted in a downgrade to my EBITDA forecast by about 1%, and that flows through to a downgrade to my cash flow forecast of about 3%. Excuse me. And that's flowed through to a reduction in my target price by about 27 cents a share, and now it's $6.77. They put out first time DPS guidance yesterday, so it was 33.5 cents. I was top of the market targeting 34.5. That delta can be entirely explained by that increase in cost that's actually coming through. So I think their settings for that distribution are actually appropriate now. Look, as well as the underlying valuation support that that sort of drives through to my ad rating, the ad rating is also predicated on my view that Sydney Airport won't proceed with the development of the second Sydney Airport. Now, look, while SYD is not obligated to respond to the federal government's notice of intention until the 8th of May, I took a lot of comfort from what the CEO said yesterday. She basically said that private funding of the airport is deeply uneconomic. So I sort of took that as a strongest signal yet that Sydney would not be proceeding with that right to develop the airport. So with the exposure to that international traffic growth that's coming through, forecast growth in cash flow and distributions over the next 3 years of about 8% CAGR, 5.5% yield, 11% upside to my target price. Quite happy to keep the ad rating on the stock.